Every day, trillions of dollars move across the world. Oil tankers leave ports in the Middle East. Microchips travel from factories in Asia to assembly lines in Europe. Wheat moves across oceans to feed entire nations. But behind almost every one of these transactions sits the same currency, the United States dollar. And here's the strange part. Most of the people using those dollars are not American. Banks in London settle trades in dollars. Corporations in Germany borrow in dollars. Governments in Asia store their national savings in dollars. Even countries that compete with the United States still depend on the same system. But most people never stop to ask why. Why does one country's currency sit at the center of global trade? Why do nations with their own economies, their own industries, and their own ambitions still rely on the dollar? And perhaps the bigger question is this: if the United States now carries enormous debt, if new global powers are rising, and if the world economy is rapidly changing, why hasn't the system already shifted? Because the truth is, the dollar's dominance was never just about money. It was about a system. A system built after the most destructive war in human history. A system strengthened by global trade, energy markets, and financial networks that now move trillions of dollars every single day. And even today, when that system is being quietly challenged, the dollar still sits at the center. But once you understand how this system was built, you begin to see something most people never notice. The real power of the dollar is not the paper itself. It is the global machine built around it. Before we understand why the dollar sits at the center of the world economy, we need to start with something simpler: what money actually is. Most people think of money as something physical: a note in your wallet, coins in a jar, numbers inside a banking app. But money is not valuable because it is paper or metal. Money works because people believe other people will accept it. It is a shared agreement between millions of strangers who may never meet each other but still trust the system enough to participate in it. When you work and receive money, you are trusting that the same money will allow you to buy food, pay rent, or invest in the future. When businesses accept money for their products, they trust that the same currency will still hold value tomorrow. Without that shared belief, money stops functioning. History has shown this many times. Entire currencies have collapsed when governments printed too much money, when political systems broke down, or when inflation destroyed public confidence. When trust disappears, money can become worthless almost overnight. This is why strong currencies depend on something deeper than paper. They depend on trust in the institutions behind them. People must believe that the government issuing the currency will protect its value, maintain stability, and honor its financial obligations. When that trust exists, the currency survives. When it disappears, the currency fades away. But some currencies go even further. They become global currencies. These are known as reserve currencies. A reserve currency is money that governments and central banks hold in large quantities because they believe it will remain stable for long periods of time. Instead of keeping all their savings in their own national currency, countries store part of their reserves in a currency that is widely trusted across the world. This creates a common financial language. If two countries want to trade, but their currencies are unfamiliar to each other, they often use a reserve currency as the middle ground. It simplifies trade and reduces risk. For example, if a country in Asia wants to buy oil from the Middle East, both sides need a currency they trust. That is where reserve currencies become powerful. They are not just used within one nation, they become the money of global trade. Throughout history, different currencies have held this position. In the 1600s, the Dutch guilder became one of the first global trade currencies because the Dutch dominated international shipping and finance. Later, the British pound took over as the world's primary reserve currency during the height of the British Empire. Britain controlled major sea routes, global trade networks, and the financial center of London. For more than a century, global commerce revolved around the pound. But reserve currencies rarely remain dominant forever. When the economic power behind a currency begins to weaken, the system slowly starts to shift. Wars, economic crises, and political changes can reshape the global balance of power. And in the early 20th century, the world experienced a series of events that would permanently change the financial system. Two world wars devastated much of Europe. Factories were destroyed, infrastructure collapsed, economies struggled to recover. Countries that once dominated global finance suddenly found themselves overwhelmed by debt and rebuilding costs. But one country emerged from this period in a very different position: the United States. During the first half of the 20th century, American industrial power expanded rapidly. Its factories produced steel, machinery, vehicles, and consumer goods at an enormous scale. While much of Europe was rebuilding after the war, the United States was already producing for the global market. At the same time, another important shift was happening quietly. Gold was flowing into American reserves. At that time, gold still formed the foundation of the global financial system. Countries backed their currencies with gold, and international settlements often relied on gold transfers. By the end of World War II, the United States held an extraordinary share of the world's gold reserves. Nearly 2/3 of the world's official gold reserves were stored in American vaults. That concentration of wealth and stability gave the United States something no other country had at the time: the ability to help redesign the global financial system. And in 1944, as the war was nearing its end, representatives from 44 nations gathered in a small town called Bretton Woods. Their mission was simple: create a new financial structure that would prevent the economic instability that had contributed to the Great Depression and the war itself. What they built would become the foundation of the modern global monetary system. And at the center of that system would be the United States dollar. In 1944, as World War II was approaching its end, leaders from 44 nations gathered in a quiet town in New Hampshire. Their goal was not simply to end the war, it was to rebuild the global economy. The previous international system had collapsed during the Great Depression. Trade had broken down, currencies had lost stability, and financial chaos had spread across nations. Many economists believed that this instability helped create the conditions that led to war. So the leaders at the conference wanted something new, a system that could create stability for global trade. And one country was in the strongest position to support that system: the United States. At that moment, America had the largest industrial economy in the world. Its factories had expanded massively during the war, producing weapons, vehicles, machinery, and infrastructure at an enormous scale. While Europe and parts of Asia were rebuilding, the United States already had a fully functioning industrial base. But the most important advantage was gold. By the end of the war, the United States held the majority of the world's gold reserves. This meant the American financial system had a level of backing and stability that few other nations could match. So the new agreement created at Bretton Woods placed the dollar at the center of the global financial system. Under this arrangement, the US dollar was directly tied to gold. 1 ounce of gold was fixed at $35. Other countries then linked their currencies to the dollar. This meant the dollar effectively became the bridge between global currencies and gold. Nations could trade with each other using dollars, knowing those dollars could still be converted into gold through the American system. For the first time in modern history, the world's financial structure revolved around a single currency. And for the next 2 decades, the system worked. Global trade expanded, economies rebuilt, international finance became more stable than it had been in decades. But the stability of the system depended on one fragile promise, that every dollar could always be exchanged for gold. And eventually, that promise would become impossible to keep. By the late 1960s, the system created at Bretton Woods was beginning to show signs of strain. The United States was spending heavily. The Vietnam War was becoming more expensive, and large domestic programs were expanding government spending at home. As a result, more and more dollars were entering the global economy. At first, this did not seem like a problem. But the Bretton Woods system was built on a promise: every dollar could be exchanged for gold. And slowly, other countries began to notice something important. There were now far more dollars circulating around the world than the amount of gold held in American reserves. Some governments became uneasy. If everyone asked for gold at the same time, the United States would not have enough to honor the promise. So several countries began converting their dollars into gold. As gold started leaving U.S. reserves, pressure on the system increased. Confidence was weakening, and the global monetary structure was becoming unstable. Then, in 1971, the United States made a decision that permanently changed the financial system. President Richard Nixon announced that the dollar would no longer be convertible into gold. The link between the dollar and gold was officially broken. For the first time in modern history, the world's most important currency would not be backed by a physical commodity. It would be backed by something else: trust in the economic and financial strength of the United States. Many economists predicted this would lead to the collapse of the dollar's global role. Without gold behind it, they believed other countries would abandon the currency. But something unexpected happened. Instead of losing its position, the dollar adapted to a new system. Because even though the gold link was gone, the world's trade networks, banks, and financial markets were already built around the dollar. And another powerful system was about to reinforce that dominance: the global energy trade. After the dollar was separated from gold in 1971, many people believed its global dominance would quickly fade. Without gold backing it, the dollar was now a pure fiat currency, money supported only by trust in the government that issued it. For a moment, the future of the global financial system looked uncertain. But another structure quietly began strengthening the dollar's position: energy. During the 1970s, the United States reached strategic agreements with major oil-producing nations, particularly in the Middle East. These agreements shaped how the most important commodity in the world would be traded. Oil would be priced and sold internationally in US dollars. This created a powerful economic loop. Any country that needed oil, whether it was Japan, Germany, China, or India, first needed dollars to buy it. That meant governments and companies around the world had to hold large amounts of dollars simply to participate in the global energy market. And because oil exporters were receiving huge amounts of dollars, they needed somewhere to place that money. Much of it flowed back into the American financial system. Oil-producing nations invested their earnings into U.S. Treasury bonds, American banks, and dollar-based assets. This process strengthened demand for the dollar while helping finance the U.S. government. Economists later called this structure the petrodollar system. Over time, this system became deeply embedded in global trade. Major commodities like oil, natural gas, and metals were priced in dollars. International loans were often issued in dollars. Global banks created enormous markets for dollar-denominated assets. The result was a network effect. The more the dollar was used, the more necessary it became. Even countries that had political disagreements with the United States still depended on the dollar to participate in global markets. By the late 20th century, the dollar was no longer dominant simply because of gold. It was dominant because the entire architecture of global trade had been built around it. And once a system reaches that level of integration, replacing it becomes far more difficult than most people imagine.
Today, the global economy looks very different from the world that created the dollar system. New powers have emerged. China has become the world's largest manufacturing nation. Europe has built a massive economic union. Technology is transforming how money moves across borders. At the same time, the United States carries an enormous national debt, and many analysts question how long the dollar can remain at the center of global finance. On the surface, it seems like the perfect moment for another currency to take its place. But replacing a global reserve currency is far more difficult than it appears. Because reserve currencies are not chosen by announcement. They are built through decades of trust, financial infrastructure, and deep markets where enormous amounts of money can move safely. And this is where the dollar still holds an advantage. The United States has the largest and most liquid financial markets in the world. Investors can move billions of dollars into U.S. Treasury bonds quickly and with relatively low risk. Global banks, pension funds, and governments rely on these markets because they provide stability and flexibility that few other systems can match. Other currencies face limitations. The euro represents a large economy, but the financial system behind it is divided among multiple governments. China's currency is growing in global trade, but strict controls over capital flows make many international investors cautious. For a currency to replace the dollar, it would need not only economic strength, but also open financial markets, global trust, and a system capable of handling trillions of dollars every day. So far, no alternative fully provides all of those conditions. This is why even during global crises, money often flows toward the dollar rather than away from it. The system may face pressure. New payment networks may emerge. Global power may gradually shift. But financial systems rarely change overnight. They evolve slowly over decades. And for now, despite its challenges, the dollar still sits at the center of the global financial machine. Not because it is perfect, but because the world has not yet built a system strong enough to replace it.